Greetings, everyone. I'm Cathie Wood, CEO and CIO of ARK Invest, and it is actually 1 week after Employment Friday, but Employment Friday was on Good Friday. So here we are again. I know we did an In the Know recently with Art Laffer all around the bank crisis. So the good news is that something did break to at least get the Fed to think about what it's doing. The bad news is, 2 days after Silicon Valley Bank went under, along with Signature Bank, the Fed raised interest rates 25 basis points. The Fed has never before this time raised interest rates in the middle of a crisis. And here again, they're talking about another 25 basis points in early May. With today, I think it was Christopher Waller coming out. He's at the St. Louis Fed and talking about inflation just being way, way, way too high. And so I'm going to go through, as usual, fiscal policy, monetary policy, economic indicators, market signals, which the Fed does not seem to respect, but we think that it will follow these signals ultimately, and then a little bit about innovation. All right, so fiscal policy. The debt impasse still seems to be out there, and it looks like raising the debt ceiling, the imperative will come sometime in June, we think. So we'll have another few months. It doesn't seem like there's much movement at all. And yet we know that Republicans and Democrats don't want to go through another 2011 where the ratings agencies downgrade our debt. So we assume they'll figure it out, but so far, very little movement there. The one thing that is becoming clear, and this is really a throwback to the early days of my career, the bank crisis seems to be facilitating, in a sense, what we used to call crowding out back then, really the public sector crowding out the private sector. And how is that happening? Well, we're seeing deposit outflows from the banking system, so that's the private sector, into money market funds and especially treasury securities, a little bit of a flight to safety. So what is that doing? It's actually accommodating spending, government spending. And so we're watching this carefully. If it's accommodating government spending, what will it be crowding out? And we'll get into this in a moment, but it does seem already that the commercial real estate space is one of the victims. So this could be just a slow-moving crisis. We don't know. But getting into monetary policy, it could be a slow-moving crisis, or are we talking about a hard landing? And I think, the markets are a little bit on pause now, trying to figure out, did the Fed and the FDIC come in and, rescue the banking system from a run on the banks? So far, so good. But I do think the markets are stepping back and saying, is that all there is? What else could happen now? And there are a lot of things we think that could happen now. So let's, on monetary policy, as I've reviewed ever since February of 21, M2 growth on a year-over-year basis peaked at 27% in early 21, February of 2021. Now, remember, when COVID started, the fear was that the global economy was going to shut down and go into a depression. And so fiscal and monetary policy makers around the world moved into action, and 27% money growth in the United States was one outcome. But the money growth rate started falling pretty rapidly. And over the last 2 years, it's dropped 30 percentage points. We're now down roughly 3%. That's negative on a year-over-year basis. We have never seen a 30 percentage point decline in the growth rate of M2 on a year-over-year basis ever. And we have also not seen negative year-over-year M2 growth since the 1930s. So that was the time of the Great Depression. So we're taking this seriously. And we have been taking it seriously, as I think you will recall, for the last year. To listen to the CEO of Citibank say that, wow, who could have seen this coming? And the FDIC and the Fed acted with such alacrity. She was full of praise. But actually, you could see this coming. And we've been talking about it for a year. Credit default swaps started moving up. So those are bets on bankruptcy, or their insurance policies against bankruptcy. And they started moving up last spring as the Fed started to raise interest rates. And they started moving up on banks, all banks, including the money center banks, to the point where last October, I was saying, what is going on? JP Morgan's credit default swaps are getting close to where they were in the middle of the COVID crisis. So the credit default swap market was saying something's wrong out there. And we were also looking at the yield curve. So the yield curve inverted in July of last year and continued to invert and into, really, we got to more than 100 basis points. So long-term interest rates, as measured by the 10-year Treasury yield, were 100 basis points or 1% lower than short-term interest rates as measured by the 2-year Treasury note. And so that's usually a signal that the economy is going to end up in trouble and that inflation and interest rates will come down fairly dramatically. And so that happened last July. Still, the Fed didn't pay any attention to it, it seems to us. And then in October, we wrote a letter just raising some of the issues or the conflicting evidence out there. We had credit default swaps going up, the yield curve getting more and more inverted. We had commodity prices of all kinds coming down. So that's, the early stage of the inflation pipeline. And we just asked the Fed, look, please consider there is conflicting evidence out there, and your votes, it would seem, should not be unanimous to go up 75 basis points at a clip, shocking the financial system. Well, something did break. And we all know, of course, it was the regional banking system. And it has highlighted two major mistakes that banks made. Both of them actually were very understandable, but they were mistakes nonetheless. And they made those mistakes in the middle of COVID, as the crisis was unfolding. They took a look at the Fed's forecast through the end of this year and saw that the Fed was forecasting that interest rates would go nowhere. They'd stay very, very low, move hardly at all. And so it made sense back then to take the gusher of money coming out of fiscal stimulus and ending in bank accounts and put that in very safe, long-term, government-backed securities, yielding 1.5% or so. Remember back then, the Fed funds rate was 0 to 0.25. So that it made sense back then. So the first assumption they made was that interest rates would not go up very much, if at all, which is what the Fed was telegraphing. And of course, in 2022, and over the course of just 1 year, interest rates went up 20-fold. Never happened before. 20-fold, up to 5%. And that was a shock to the banking system because with such low-yielding securities on the asset side of the balance sheet, it was very difficult for them to pay up for deposits on the liability side of the balance sheet. And so what happened? What happened was deposits flowed out and into money market funds, so out of the banking system. Now, Silicon Valley Bank happened for a little bit of a different reason, that failure. It was a venture capital funding drought. And basically, these startup companies that were banking at Silicon Valley Bank needed to fund their operations because they couldn't get any liquidity events going from the venture capital market itself. And so they started drawing down their deposits to run their businesses. But that got everybody then focused on what deposits were doing in the rest of the banking system. And lo and behold, the entire banking system was seeing deposit outflows for the same reason that deposits weren't paying much. And the rest is history in terms of the bank crisis and everything that we had to do around that. So now we come to this question of, okay, here we are now, what happens? Surely there have to be some ramifications, economic ramifications. And we can see them now in the commercial real estate market, which from what we're hearing is basically frozen. And we're beginning to see more strategic defaults and fire sale prices, anecdotally. So that's one area that we know is having problems. Why? Well, if you look at the loans to the commercial real estate market, somewhere between 60 and 75% of them, depending on who's measuring, emanated from the regional banking system. So that's a problem. Now, because deposits are still in outflow mode. But then we come to, so that could be a slow motion, I don't know if we should call it train wreck, but it's not a good situation for commercial real estate. But there is a hard landing possibility here as well. And for those of you who listened to the podcast with Art Laffer, forgive me, I'm going to go through this again, but there's a very simple identity in economics. Most people who take macroeconomics 101 learn it in that class. And it is that MV equals PQ. So PQ is price times quantity, and that's nominal GDP of the economy. So the production of goods and services in the economy. The other side of that, and these two have to equal, is MV. Well, we know that money supply on a year-over-year basis is going down about 3% year-over-year, our estimate for March. And on a sequential basis, it's going down even more rapidly. So to plug that hole and to figure out what's going to go on here, we need to know what V is. V is the residual value. And if you look at what happened in the first quarter, it looks like nominal GDP was up roughly 7%. We have these numbers, I'm just rounding them. Up roughly 7% on a year-over-year basis. You've got money down 3, so that means velocity was up roughly 10 on a year-over-year basis. Now, velocity, if you look at it over history, you'll see that it peaked secularly in 1997 and has been falling from a trend point of view ever since then. Now, what happens is during a recession or a crisis is velocity falls dramatically. It collapsed during COVID, for example, and during 08-09. And after the shock of those experiences, it tends to rebound back to trend before resuming its decline. Well, it started rebounding. It has not gotten back to that downtrend line. And what worries us and focuses us on the possibility of a hard landing is the crisis, the banking crisis. Typically during a crisis, velocity falls, as I mentioned before. The banking crisis happened in mid-March. And so if velocity is even flattening out, we have a problem. And we could be looking at a hard landing. Now, you'll notice that the stock market is still up year to date. And we'll talk about that in a minute. We think there are reasons for that. But just back to this hard landing, if money continues down and velocity even flattens out here, then on a year-over-year basis, it's going to be slowing dramatically from 10% in the first quarter to 5 to 7% in the second quarter. And if money is down 4%, well, that doesn't leave much room for nominal GDP growth. So if money is down, let's just say it's down 4%, and velocity is only up 7%, let's say, instead of 10% on a year-over-year basis, which means it's flattened out quarterly. So that's in response to the crisis. Then that only leaves 3% for nominal GDP growth. And that's much lower on a year-over-year basis than what people are expecting for the second quarter that we're in. Now, maybe it'll take a little bit of time to play out, but we do think that 2 to 3% nominal GDP growth or less at some point this year on a year-over-year basis is going to happen. And so something's going to give. What is it? What's going to give? We don't know. It could be consumption if the unemployment rate starts moving up. And there are some indications that we're going to have some significant surprises in terms of the unemployment rate going up. So, interestingly, in learning today that Governors Waller and one other Bullard are saying inflation's still too high. We've got to stay tough. I went and looked at their backgrounds, and I think this is true of most people on the Fed. They have no market experience, and therefore I don't think they respect market signals. The surprise to me, though, is they're economists, as many of the people on the Fed are. They're economists, so at least they should be doing this very basic, if M is falling and V is threatening to flatten out or fall, what happens to nominal GDP? So hopefully they will start talking about it. One of the good things that we did hear during the last week is a new Fed governor, Austin Goolsbee, Chicago Fed, is actually saying, you know what? The credit markets are tightening up here, and they're doing a lot of work for the Fed in terms of slowing things down. And I'm going to go out and I'm going to talk to some of these regional banks and get a sense of credit conditions out there. And we do know that surveys on willingness to lend have collapsed here. So I think he's going to find out that, yes, that's right. So here is someone on the Fed who is, willing to go out and and kick the tires and try and figure out what's really going on out there. So that's good news. One of the other pieces of good news from a monetary policy point of view is that Canada, Australia, India, and Singapore, I think this past week, have all gone on hold. And so they're looking at something concerning. And my guess is it's a very serious downturn and price deflation in a lot of trade indicators, which will come back to us. So we'll get into why the markets have held up so well. But first, let's do some economic statistics. Now, most of the statistics that have come out recently, they were taken, or the measurements were taken pre-regional bank crisis. So I'm not sure we should pay too much attention to them. The positive ones were on housing, and I think it's because mortgage rates have come down since the long-term Treasury bond yield peaked last October at 4.3%. Finally, mortgage rates started to come down. So housing starts, permits, mortgage applications, existing home sales, and pending home sales all have done a little better. I mean, housing by many measures was down 40% year over year. So I suppose we shouldn't be surprised to see some rebound there. Autos they're still in recession territory at 14.82, but they came in a little better than expected. But other than that, even before the crisis, a lot of indicators were starting to signal trouble. So employment indicators like job openings have come down fairly dramatically. They peaked at 12 million at one point. Now we're down to 9.9. The Challenger Job Survey of layoffs, which are the larger layoffs, that's up more than 400% year over year. And maybe the most important indicator is initial claims, which were revised recently. And at turning points, as I've mentioned on this webinar before, at turning points, we see massive revisions. Well, such was the case with initial unemployment insurance claims, and that's a weekly indicator. So we have some of those since the crisis, and the revisions are up 25%. 25% in an indicator that the Fed's really paying a lot of attention to, and so are the financial markets. So that was kind of interesting. And then if you look at the various regional Fed indices, they're all disappointing. So the Philly Fed, the Dallas, Richmond, and so forth. Non-defense capital goods orders and shipments, both disappointing and turning down. Today we got retail sales. They were down 1% month to month. That's not a year over year number, which was much worse than the 0.5% decline expected. But here we have to come back to seasonal factors, and they are all messed up, I think, because of weather. So you'll remember in January, we got a huge increase in retail sales, 3.1%. Now it just seems to be normalizing. So in real terms, we think consumption looks about flat for the first quarter. So not doing too well, not falling off a cliff, but there is some equivocation there, and there was even before the crisis. Then we have inflation indicators, and those are all starting to look very good. CPI up 0.1% for March, still up 5% on a year-over-year basis, and that's what those on the Fed are looking at. Big, long lags. We just got a 0.1. That's 1.2% or so at an annual rate. That's below their 2%. Core CPI was up 0.4. That was a little higher than expected and is still up 5.6. But from there, you see in the pipeline, inflation is disappearing kind of rapidly. The PPI, Producer Price Index, this is upstream, and it will feed downstream into the Consumer Price Index, down 0.5% for the month of March, up 2.7% year over year. Okay, now we have a two handle. 2% is what the Fed is looking for. And that's down in 1 month's time from 4.9% on a year-over-year basis. So more than a 2 percentage point drop from 4.9% to 2.7% on a year-over-year basis. Even core inflation, PPI inflation, so core means excluding the volatile food and energy, down 0.1% and up 3.4% on a year-over-year basis, down more than 1 percentage point from the 4.8% the previous month. And then even further upstream, which is import prices, down 0.6% in March and down negative 4.6% year over year. So I've been saying for quite some time that we believe the greater risk out there is not inflation, but deflation. And the pipeline is starting to fill up with deflationary indicators. There is one indicator that came out today. It was the University of Michigan inflation expectation, so consumer inflation expectation index. The 5-year was pretty stable at 2.9%. But the 1 year jumped from 3.6%, which is the expectation for the next year, to 4.6%. And I was kind of surprised by that. But as we were talking in our morning meeting, I was saying, what went up a lot in the last month that has the consumer thinking, inflation has taken a surge? And it is gasoline prices. So we did have OPEC telegraph to the world that they were going to cut back production by another 1 million barrels. I think that starts in May. The pricing impact has already started. And yet it is interesting to watch the oil price. If you look at the West Texas Intermediate, it dropped just below $70 and now is back to 80. But it has stopped at 80 regularly this year. And we, in our brainstorm today, we're talking about how much oil demand is being destroyed at the margin by the accelerated shift towards electric vehicles and electric vehicle miles traveled as we see more Uber drivers driving Teslas and other electric vehicles. In China, I believe that 25% of all car sales now are fully electric, compared to closer to 9%, I think it is, in the United States. And now this is going up very rapidly. And commodity prices are determined at the margin, that marginal barrel of consumption. And it seems as though with electric vehicles, we're moving away from fossil fuels. So, I've been saying that we think oil prices have a long way to fall. If you adjust oil prices for inflation, since OPEC quadrupled oil prices in the early 70s, we're already below that level. Now it is adjusting for inflation. And, the lifestyle of people in the Middle East has been upgraded dramatically since that time. And in real terms, the oil price is less than it was in that time. And we think it will continue to fall. So that could be a problem. And, we noticed how, China was able to basically help Saudi Arabia and Iran negotiate some kind of accord. And it's like, what is going on? These sorts of things happen when leaders want to change the topic from what may be going on in their own economies. Maybe, the loss of oil demand impacting the Middle East. Maybe China's recovery post zero COVID policies, maybe not so strong. And we are getting indicators that it is not that strong. Okay, so now, why has the market been hanging on? I mean, all three major benchmarks in the United States the Dow Jones Industrial Average, S&P 500, and the NASDAQ. All of them are up this year. And in fact, the NASDAQ is up the most, and that's considered the most volatile of the three. And if you look at if you look at the sectors as they're defined by GICS, you'll see they're risk-on sectors that have done very well. Communication services, which includes a lot of the FANGs, up 23%. Tech generally 19%. Consumer discretionary up 13%. That's year to date. And on the losing side of the ledger, financial services minus 4.5%. This is in the S&P index. Utilities minus 2.6, and healthcare minus 1.4. So financial services, yes, have been hit by the crisis. That makes sense. Utilities are coming down because the interest rates are coming down. As I'm thinking about it out loud, that should be helping. The dividend yields in utilities have less competition. So that's a curious one. Except that utilities are typically a flight to safety, and the market's not acting like there's a flight to safety. And healthcare has also underperformed. That tends to be a defensive category as well. So what might explain this? Well, it could be that the market paying attention in all its wisdom, even if the Fed wasn't, the market was paying attention. We were in a bear market last year, and the market was saying something's going to break here. And now we know what it is. Is there a buy on the news, or a buy now that we're near the end of this? As I just mentioned, I'm not sure we're near the end of it. I don't know why deposits are going to flow back into the banking system, given current dynamics. But if we are about to experience, some people would say soft landing. I find it hard to believe this will be soft, but soft or hard landing, what that will mean is inflation and interest rates are going to continue coming down, and the Fed will follow them finally. The markets always lead the Fed. So that could be what's going on here. If you remember what happened, our strategies, innovation-based strategies, they started underperforming in February of 21 when the whiff of inflation and interest rates going up with supply chain issues started. And the market just started discounting, saying, interest rates are going to go up at some point. This category of stocks is not going to do well. Well, we could be on the flip side of that because it does seem like innovation-based strategies have done very well. When it comes to fixed income markets, the 10-year Treasury bond yield peaked in October last year, 4.3. It did get to 4.1% in March, but then the crisis took care of that. And we're now down to roughly 3.5%. So we're down to 3.5% perhaps because of a flight to safety, and perhaps because whatever kind of landing this is going to bring with it lower inflation and interest rates. And if deflation is the risk, that actually accrues to the benefit of stocks that do well during deflationary times. And that tends to be technology. Technologically enabled innovation is deflationary. Now, the yield curve is telling us that we're not out of the woods yet either. It did drop to more than 100 basis points of inversion on March 8th, and the crisis took care of that. But we're still inverted at 58 basis points today. So now many people looked at the 100 basis points and they said, oh, well, the last time we were here was in the early 80s. We got inflation under control with 100 basis points inversion back then. And that's true. But I think the analysis is a bit off. It basically underestimates how powerful Fed restraint is today, because 100 basis points or 1% against a 15% long bond yield is a lot different from 1% against a 4% bond yield. So 1 over 15 is 6.5. Use the Richter scale here. 6.5 on the Richter scale is a pretty powerful earthquake. I've been in a couple of those, and they are not pleasant. They're actually quite eerie. 1 over 4 would be 25 on the Richter scale. We've never seen an earthquake of that magnitude. In fact, I think the highest has been 10. So I think if we look at it from that point of view, that the Fed has been making a mistake, and we are going to see more ramifications of this. Now we look elsewhere to see, okay, we look at credit default swaps. Yes, they've come in. They peaked in late September at 113 basis points. That compares to 150 during the depths of COVID, when the bets on bankruptcies were quite significant. And today we're down to 75, but still elevated from the 50 to 60 range where we were pre-COVID. High yield spreads. So in the high yield space, these are lower quality companies, more risky. In order to attract capital, they have to pay higher interest rates. And so today, we have been trading in the 5 to 6% range, really since mid last year. Pre-COVID, that did drop to 4.4. So people were feeling a little bit better about everything. Nothing had broken, and then something broke. And we went back into that 5 to 6% range, which is higher than we were pre-COVID in the 3 to 4% range. Commodities are all still, many of them are down from their peaks. Lumber down 76%. DRAM prices in the semiconductor space down 66%. Oil down 34%, iron ore down 34%, copper down 16%, silver down 11%, gold down 1% from their peaks. And all of them, except for gold, are down on a year-over-year basis. So again, in the pipeline, we've got deflation. Currencies, more signals there. Just to give you a sense of how wild the dollar has been, on January 8th of 21, the dollar was at 89. DXY is the trade-weighted dollar. So it's the dollar measured against other currencies according to trade weights, are trading with them. It went up 29% to September 30th of last year, 29%. And interestingly, what happened soon thereafter, that was the peak, and soon thereafter, the bond yield peaked. And, it's interesting to make these connections. Now, the bond has dropped, the dollar, DXY, has dropped 13% since September 30th, but is flat on a year-over-year basis. So what that tells me is that the risks associated with the dollar going up 29% were highly deflationary. We're hurting the rest of the world, and the dollar going down has given them some relief. I think the most remarkable of all the indicators that we monitor was Bitcoin during the crisis. Now, it typically acts like a risk off. It tends to do poorly during risk off periods. This time it did the opposite. From March 10th, when it bottomed at 19,500, it has soared 55% to $30,270. Ether has gone up 51% from 1370 to 2076. So these previously volatile, risk-on metrics are acting like flight to safety. Well, we think this is a theme that you should be watching out for. We think a lot of innovations out there are going to be the flight to safety. Why? Because they're going to disrupt the traditional world order. What are Bitcoin and Ether doing? They are, by the very fact that they're being considered flight to safety, like gold, that's really interesting and suggests much broader based adoption and acceptance than I think most people understand. And given the governments railing against crypto and really putting pressure in all kinds of regulatory ways on it, we do believe this is going to become an election issue. What's been interesting about this flight to safety is the mega cap tech stocks have been beneficiaries. And we believe that that's a bit of a head fake, and it will not be sustained. And in fact, the FANGs, the former disruptors, are being disrupted more and more. We know that TikTok has taken a lot of consumer mind share from Facebook and Netflix and other social networks. We know that social commerce is taking share from Amazon, which isn't a social media site. And we know that ChatGPT with plugins is, we think it's a big problem for Google and its search franchise, and even for Apple with plugins. We may not have to go to any app. ChatGPT might just take us straight to OpenTable. And that way, Apple won't get its 15 to 30% tax. So we're sure they'll all pivot. We know Apple has a lot of fintech and healthcare and everything. But, its apps, that was recurring revenue. Apps and other services were recurring revenues as opposed to the hardware, which is not recurring revenue, at least not annual recurring revenue. So we would say that there is a flight to safety, certainly led by crypto assets. And it is telling us that the world is transforming and will continue to transform. You cannot stop innovation. In fact, the electorate will make sure of it. I hearken back to the early days of Uber, and I was sure, I was working in New York at the time, and I was sure there's no way Uber would get through the New York Taxi Commission. Well, it blew right through it because the consumer wanted it. It made the consumer's life easier, more convenient. And we think that's true with all of the innovation that's evolving today. The multi-omic sequencing technology it's unlocking the secrets to life and death and to extending life and curing disease. Robotics, autonomous mobility is going to be here, we think, before anyone believes, now that Elon Musk has prepared us for so many years. Now that no one believes him, it's going to happen. That's what usually happens with innovation. It happens slowly until all of a sudden it takes off. Energy storage, we're already seeing that with electric vehicles. I think the auto industry is pretty stunned at how quickly it has had to pivot. Artificial intelligence, training costs dropping 70% per year. Had GPT been 3 from which ChatGPT, which has captured the imagination of the consumer and really given innovation a breath of fresh air in terms of the market recognizing that, hey, something's going on here. Had it been developed in 2015, it would have cost $800 million to develop that model. In 2020, which is when it was developed, it cost $4.5 to $5 million. Today, $450,000. And in 2030, $300. That's how quickly the world's changing. And AI is the biggest catalyst to all of these other innovations. And we believe will insinuate itself into those innovations in a profound way, even with blockchain technology in ways that we cannot even imagine now. So we're pretty excited about innovation. This time is so different from the tech and telecom bubble. The tech and telecom bubble is when the seeds were planted for everything that's happening now. In fact, the seeds were planted from 1980, the PC, to the internet. And it has taken 25, 30, 35 years of germination. But now the seeds are coming to life. And these are astonishing innovation platforms. And we do believe they will become the flight to safety as investors get away from the benchmarks, which really are all about past successes, and starts focusing on the future. After all, what is investing but about the future? So with that, I wish you all a very happy spring, and we'll be back next Employment Friday.